Welcome. In this video, we are going to learn about how, in the short run, the financial markets have an impact. Yeah. And primarily, if you remember one thing from this entire video, it would be that in the short run, the central bank determines the interest rate. There are three key ways in which they do this, and one being the primary of the three. We will learn all of them, but the central bank in the United States, it's the US Federal Reserve. That's the central bank. It has a huge role to play in the short run on the interest rate. Yeah, so that's the key takeaway. And let's learn some of the details and exciting um, uh, reasons how it actually happens. So to quickly get us all on the same page on the terminology, let's uh, find out, where we all are. Yeah. So we know money. We've seen money. Yeah. We've seen the dollar bills, currencies, $1, $5, $10. I've not seen the $2 bill for a long time, but we've seen all these other dollar bills. Yeah. So when we see this, we call this money, um, and we can also call this currency. But money, in a sense, the terminology we will use is money is what we can use to pay our bills. Yeah, this is liquid money. You can pay your bills using cash, which is this currency. You can also pay your bills using your checking accounts. You can write a check. You can pay your bills using your credit cards, which can be paid off from your checking account. So, in a sense, your liquid money that you can use to pay bills is what we call, let's say, money. Currency is one way. The dollar bills that we see here is one form of money. Checkable deposits is also a form of money, which is what you can pay for your credit cards, your bills, etc. Yeah. Income is what you earn in a given year. Yeah. So we often say, how much money did you make? Well, uh, in the economist, pure economist would use the term, how much was your income, right? How much was your income? Because it's a flow variable. In a given year, you make some amount of money or income. So you have income is what you earn in a given year. Yeah, it's a flow variable. Saving, without an S, saving is the proportion of your after tax income that you do not spend. Yeah, from the money you made in a given year. Again, saving is a flow variable. You'll pay taxes first, that's inevitable. After paying taxes, what proportion of it that you did not spend is your saving for that year? Savings is the value of all of your saving over time. Yeah, so it's a stock variable, but a saving is a flow variable, which is in a given year. If you have something in a given year, it's a flow variable. If it's a given point in time, the accumulation of everything, it's a stock variable. Yeah. Wealth is also a stock variable. Wealth, different from saving, is um, it reduces all your liabilities. So assets minus your liabilities is wealth. Yeah. So, and it's again a stock variable. You say, hey, what's your wealth at the current point in time? So that's wealth. Investment is when you purchase um, capital goods like machinery. Yeah, it's a stock variable. Like, what's your total investment? But we also use investments in in terms of financial investments. Yeah. So, but investments in pure economic term would mean purchase of capital goods, investment in, let's say, you buy land, machine, all of that is capital goods that you can use. Financial investment is the purchase of financial assets. Could be stocks, mutual funds. um, by stock, I mean company shares or company stock or bonds that you use that pays you a return. A bond is a financial investment that pays you interest for the money that you use to buy the bond. Yeah. So it gives you a fixed interest. A stock a company stock will not have a fixed return. It depends on the market, what the stock value is, what the company owners decide in terms of capital allocation, distribute you money or not. So this is important for us to get the terminology right, because without it, we will just use terms interchangeably. Yeah. And the textbook uses this also in detail. So we see currency, great. That's currency or money, right? In that terminology. The US dollar currency is used not just in the US. That's another fun fact. Yeah, it's used in the United States, including these five territories, also various other countries. So if you take a look at this, Argentina, Cambodia, Venezuela, Zimbabwe, they they use US currency quite a bit, actually. So this is a good insight to know that the United States dollar is not just used in the United States, but it's used quite a bit. Yeah. And we will learn way more about the US dollar, its reserve status, how much it's used over time. But let's just get the terminology on the same page. Having done this, um, did you know that 2.4 trillion US dollars is currently in circulation? And we can get this data from Fred, our famous and our favorite website, Fred. Yeah. We can go here and we can look at CURRCIR, currency circulation. So that is the ticker that in Fred, St. Louis Fed, we can go here, fred.stlouis.org, currency in circulation. So it gives us how much currency or money is in circulation. And it's about $2.4 trillion. Yeah, hard cash in circulation. So this is not the money that's stored in the Federal Reserve vault or the commercial bank vault or is part of the reserve requirement in the Fed. This is actually money in the economy, like out there. Yeah. And so this is an important metric to know, like how much money is currency is out there. So 2.4 trillion. Um, and who holds this money? Like, most households, so roughly, let's say 320 million people, 100 to 150 million households. Does the US households own this, or who has this money? Like, who is holding all of this money, right? And that's an important thing. So some of this is not, there's approximate numbers available, but more than 50% of this, as of a few years ago when we got some of this data from this international role of the US dollar from the Fed blog post, it tells us that more than 50% of it is held abroad, US currency, which is a big number, meaning about 1.2 trillion is not even in the United States. Now that's comforting because not a lot of people carry a lot of cash, right? So knowing how much money are we talking about and how much is in the US and how much is not in the US is helpful. Primarily, if you go beyond currency into treasuries, right? So treasuries is beyond just currency. Like there are various types of US treasuries. The T bills, which have maturity anywhere from weeks to less than a year. T notes, treasury notes, which have maturities in a few years, less than 10 years. T bonds, long-term maturities, less than 30 years, and TIPS, bonds indexed to inflation. So there are these different types of treasuries, and we start to see that Japan owns more than $1 trillion of United States treasuries. So remember, this is beyond the 1.5, $1.2 trillion in currency. This is treasuries overall, which is not currency. Yeah. So these are promissory notes that these government agencies issue that are owned by all of these countries as well. So take a look. China was the second largest, was around 850, but it's slowly reducing. United Kingdom the third, and India is slowly inching up every year, just inching up. Yeah. So we can get all of this data from the treasury.gov website, which tells you what 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 is the trend over time for all of these countries owning the US dollar in terms of treasuries, how much each of these countries are owning US. Yeah. So the fun fact here is that if there is a 50% of US currency, like about 1.2 trillion, owned outside or held outside the US is able to use that as interest free, right? Because that money that these people are holding, they're not getting any interest. So US expenditure is being financed interest free for all of the money that's held outside of the US. So that's a fun fact. Also, knowing that US treasuries, which do provide interest, all of these do provide interest in terms of treasury bills, treasury notes, treasury bonds, because these are not currencies. Um, and these provide interest. And where do they come from? They come from the fact that annually, if there is a fiscal deficit in the United States, meaning the revenues don't cover up for all of the costs, then the government needs to raise money to able to fund those government programs, which require more money than the revenue they're getting in taxes. So they do that by issuing these US treasuries, and that's how they're able to fund these budget deficits. Yeah. And these foreign countries are willing to buy these treasuries because they have faith in the United States government, which has not defaulted yet, that it would always pay back the principal and the interest. Yeah. And it's super liquid. If you look at this, about $1 trillion, that's a lot of money, more than $1 trillion, and hundreds of billions of dollars for all of these countries. It's a lot of money that they're holding in reserve because they think they can use it as a foreign reserve. They can, if they have an import, they can pay their bills using the foreign reserves that they have, which is quite liquid. So we understand different aspects of money, currency, treasuries. Having known these terminologies, we can start to understand the demand for money and eventually supply for money, because that is important to know and understand how it works. Yeah. So now let's understand demand for money. So before I show you this, right? Um, would you if would you pay higher interest rate if there are 10 banks willing to compete and get you as a customer, or would you pay less interest rate? Think about it. When a lot of people are willing to compete to get you as a customer, they'll typically, try to give you the best offer, right? So, demand for money, right? As more and more money is going to be demanded as the interest rate goes down, right? Does this make sense? Yeah. Demand for money goes up, so the quantity of money needed goes up as interest rate goes down. If you were borrowing money, would you borrow it at a higher interest rate or at a lower interest rate? You would borrow it when it's lower interest rate for you to borrow. So you would, as a consumer borrowing money, would borrow more money, and there's going to be a higher demand for money when the interest rates are low, because it's cheaper for you to borrow money and actually spend. So that's also showing this relationship, meaning if the interest rates go down, the quantity of money demanded goes up. Yeah. So demand for money follows this downward sloping curve to the right. Yeah, this makes sense. In a sense, we can then form an equation for demand for money. MD, demand for money, depends on the nominal income. So we've covered GDP, the nominal income, yeah, times interest rate, some factor of interest rate. And in this case, we say that it's a negative factor, meaning if interest rates go down, the demand for money goes up. So yeah, it's negatively factoring in. and and we learn about this aspect as well, which is theta, or the reserve requirement. But for now, let's pause. Do we understand this, which is demand for money depends on the nominal income times the interest rate. So we understood the interest rate as we went through this diagram, but then what is this nominal income? Let's cover that as well. So let's say today you're making $10,000, and next year you make $20,000. If your income has gone up, would you be spending more on multiple goods and services, or would you be spending less? Think about it. You would spend more. So if your income goes up, your nominal income goes up, your money demanded goes up because you would have more needs to spend on more expenses. So demand for money directly is impacted by your income and negatively impacted by interest rate, which we saw here. Yeah. And what is the third aspect? This is the reserve requirement. So at any given point in time, you are trying to make a decision. Should you keep your money in the bank or should you invest it? Yeah. You would keep as much money in the bank that is proportional to your income because you would have that proportional need for your expenses. You would pay for your expenses. And so your expenses directly tied to your income. So you would only keep as much money needed to pay for all of your expenses, but rest, if you're getting a really good return, you would actually invest. Yeah. So at any given point, a country in an aggregate basis also having the same dynamic. How much money is the country making? And by that factor, you would know how much would be their expenses. And for those expenses, it has to be liquid money that it's available that they can spend, but also directly negatively impacted by the interest rate. Higher the interest rate, the lower the demand for money because people will be like, hey, I take my money and give it and put it in bonds that give me higher interest rate because I can just get money from it because I don't need it. Yeah, so extra money would go into bonds as interest rates go up. So the demand for money would go down, right? Okay, so we understand that. And so what is this third part? The third part is the money that you put in your bank. Your bank, on an aggregate basis, would take all of the monies that are deposited and deposit some proportion of it in the Federal Reserve, the central bank. It cannot use all of that money to lend out or, yeah, so it has to reserve. There's a proportion. Up until I think before COVID, that proportion was 10%, but now it's 0%, meaning you don't have to have any reserve requirement. Um, and so you quickly realize that there is three aspects. How much is your income, which has a direct impact on your expenses? What is the interest rate, and what is the reserve requirement? So that changes the demand for money. Yeah. So what is the level of transactions that you have? What is the interest rate, and what is the bank reserve ratio? Yeah. Um, so if you're getting higher interest rates, your money from the bond, you would prefer to invest that in the bond. If you don't need that money, that makes sense. Um, and your demand for money would shift if your income shifts. Yeah. So if your income shifts now from here to here, then all of a sudden you would have higher demand for money. Yeah. So for the same interest rate, if your income shifts, demand for money would be higher. Yeah. So theta here is the reserve ratio. So every time you have a checkable deposit in the bank has to have some amount of reserve that it needs to park with the central bank. So your commercial banks has to park, I think it was before COVID, it was around 10% was the reserve requirement. Currently, it's at 0%. So we can quickly understand that the demand for high-powered money or is going to be proportional to the income times, and it will have a negative relationship with interest rate, and also it'll have an impact based on the reserve requirement. So we understand how money requirement for demand for money is. Now let's go to the next aspect, which is um, the supply for money. Yeah, because if we understand demand and we understand supply, then we can find out equilibrium. So supply for money. Before that, a fun fact: did you know that there used to exist $500 bills, $1,000 bills, $5,000 bills, $10,000 bills, and even $100,000 bills? Yes, these were all monies that were supplied some time back. No longer we have more than $100 bill. But like, where does money come from? Where does the supply of money come from? Yeah, it's a super important aspect to really deeply understand. But in a sense, um, there are three possible ways. So let's go through each of them. Yeah. Um, so if the United States um, has a deficit, yeah, the yearly budget has deficit, then what will happen is that the government would authorize United States Treasury, which is also part of the government, to sell treasury bonds. Yeah. So we looked at various types of treasuries. Yeah. So treasuries, T bills, T notes, T bonds. So what they'll do is they will sell a bond to these commercial banks. So these are, um, and there are specific types of primary um, commercial banks that are eligible to buy these government bonds. And what happens then is that these bonds are bought, and then what they promise is interest on those bonds along with payment of the principal when they mature. And so the commercial bank can give money to the government by who has sold the bonds. And so the governments can use it in the government programs, and those would eventually end up with individuals and businesses on whom they spend those money. So we quickly realized that the commercial banks was able to, when they buy those treasury bonds, will give back. So they buy bonds, they give money, or they give money, they supply money, is one way. Yeah. But the Federal Reserve in the open market can also, through the secondary market, buy those government bonds from these commercial banks. And when it buys it, Federal Reserve has the ability to supply or print money. By printing money, it's not really printing those hard currencies, is what we mean by printing money. It's basically just an entry in a computer, a digital entry that says print $100,000, or so now they have $100,000 available. Yeah. So the Federal Reserve buys this treasury bonds and then gives it to the bank. The bank can in turn give it to the government agency from which it owned the bank. It no longer, if it, let's say the commercial bank no longer wants to own those bonds, then the Federal Reserve will own those bonds. Yeah. So the Federal Reserve was able to create money. Yeah. Because from where? Out of thin air. It's able to create money and give it to these bonds, the government bonds that are issued by the United States government. So that is the first major way of the two key ways in which money is created. I mentioned three, but there are two main ones. The Federal Reserve, when it buys these treasury bonds, then it's able to supply money. Similarly, when the commercial banks, let's say you and I go to a commercial bank, we go for a mortgage loan. The commercial bank can create new money from where? Out of thin air. It can, it can, you can get a loan, or you would, um, you would get into a contract that says, I promise to pay this uh, money with this interest to the bank, and the bank has that promissory note, uh, or that contract that says you have this debt, and then the bank deposits that money in your bank account for the loan that you just took. From where? Out of nowhere. So the commercial banks create money. It's able to create money based on the debt that you took on. Yeah. And worst case, if you, let's say, are not able to pay back the money, then they'll sell your home and retrieve back the money, yeah, that it gave you. And remember, when they give you that money, it eventually you would sell it. You would pay that money to the seller of that home that you're trying to buy, or the car that you're trying to buy, and eventually um, that money would get back into the economy. So that's the second big aspect. Yeah. So as I mentioned, the US government authorizes the US Treasury to fund the deficit, and it can buy either T bills, T notes. And when the treasuries are sold in the secondary market and the Fed buys them, it creates money supply, but also the commercial banks. Yeah. And I was quite surprised to find out just from the latest numbers, but that has been the case for some time, is that 90 to 95% of new money gets supplied via this route, which is huge, right? But depending on like how active the Federal Reserve is during various, let's say, quantitative easing scenarios where it actually has to take a lot more steps. But if it's just doing the open market operations, that contributes to about 5% roughly. Again, these numbers are very much approximate, but you get the high level range of where this is created. This commercial banks create a lot of money, close to 90-95%. Um, and and when they create this money, right, um, they might also want to borrow money from other banks. So if one commercial bank, let's say Wells Fargo, wants to borrow money from um, Bank of America, or wants to park its money in the overnight, um, park its money overnight, then the Federal Reserve, the market where that happens is called the federal funds market, and the Federal Reserve controls like the overnight rate at which this lending can happen between banks, or which is a huge way in which the Federal Reserve controls um, overall the money lending rate, yeah, which is huge. The federal funds rate is what we call the FOMC meeting that happens, that specifies the federal funds rate on how much money these banks are able to park and what interest they get. Yeah. Finally, there is actually the third one, which is if the Treasury prints actual hard currency. So there are indeed three. I take it back. Uh, if the Treasury, through the Bureau of Engraving and Printing, part of the Department of Treasury, if they print hard cash or coins, then that is supplying new money as well. Yeah, so that's the third one. And but that's a very small percentage, like 3% roughly, of where new money gets created. And so you get some sort of a range of where this supply of money is coming from. Yeah, in a pretty big way. And you would quickly realize that the Federal Reserve has a huge role to play here. The commercial banks have a huge role to play here, but also the Treasury, they can print hard cash. Yeah. This could be surprising that the overall volume here is much smaller compared to these two. Yeah. But now we understand the supply of money, how money gets created from thin air. Yeah. And it's backed on debt. In some sense, you would sell bonds and get money, and hopefully those bonds would be paid. And these bonds, the US Treasury bonds, are backed by the faith of the United States, and they have not defaulted. And so that is the promise that it holds on. Yeah. So understanding demand and understanding supply can help us very quickly understand equilibrium. Equilibrium is when the demand for money is equal to the supply of money. Yeah. And that is the point where the demand meets the supply, is where we have the interest rate, the equilibrium interest rate. Yeah. So if we have money supply, um, we we have this line here, because the money supply is fixed, you get interest rate. That is the equilibrium interest rate. Yeah. Um, and it's important to understand what the equilibrium interest rate is, because there could be shifts in money supply, and how does that impact the interest rate? And there could be shifts in demand for money. How does that impact um, the interest rate? So the first one, if there is an increase in demand for money, for example, let's say the nominal income increases, yeah, then what we see is that the demand for money, this green line, shifts here, and so there is an upward pressure in the interest rate. Yeah. So if the nominal income increases, we start to see an increase in interest rates. Similarly, the supply of money, if more and more money gets supplied, then we start to see that the interest rates goes down. Yeah, so if the supply of money went from MS to MS dash, we start to see that interest rates goes down. So the Federal Reserve, let's say, starts buying bonds over and over and supplies money, or there's more and more loans given out by the banks, we start to see that the supply of money shifts to the right, and so the interest rates would go down. So now we understand how supply and demand impacts the equilibrium interest rate. It's super important to know, because then you would know whether there is an expansionary open market operation happening, which is this scenario here, where the interest rates would go down, or there's a contractionary, uh, where it goes from here to here. Yeah. So let's go a little bit in detail to understand. So what does it mean for us to have an increase in nominal income? So when this green line MD moves to MD dash, we see that the demand for money exceeds the supply. Yeah. So we start to see, when you have the demand, there's way more people asking for that money. Um, you would automatically see that there is a pressure upwards, because there is less of it available and the demand is high. So that makes sense. Yeah, there's an upward pressure because there's more and more people wanting it, and there's not much available. The supply is, let's say, fixed in that sense. Then all of a sudden the interest rates would go up. Similarly, when the expansionary open market operation happens, wherein the central bank, the Federal Reserve, buys the bonds. When it buys the bonds, what happens is, um, it typically would buy the bond and then give back money. Yeah, so now it has pumped money in, and when it pumps money in, this money supply goes up. So there is higher supply, then the demand hasn't moved, so there's more money available. And so when more people are willing to lend you money, they'll give you at a lower and lower rate, so that you could actually take that money and invest. So that leads to eventual decrease in the interest rate. The Federal Reserve would look at in the opposite way. They wouldn't look at like, hey, how much money I need to supply. They would look at, this is the interest rate is my target, and then they'd say, hey, for me to reach this interest rate from here, I need to move my money supply from here to here. So they'll shift the money supply based on this target, and not the other way. Meaning they'll not look at, okay, I need this to be the money supply, so that they'll start from what is it, the interest rate that I'm interested in, and then that will determine how much the quantum of money supply they would inject in the economy. Yeah. So we understand now expansionary policy, and similarly the opposite is contractionary open market, where they sell bonds and they're like, hey, I'm going to dry out the liquidity. I'm going to keep buying. I'm going to keep selling um, bonds, and so when I sell the bond to you, you would have to give me cash. So they will keep take the money out of the equation. Yeah. So we now understand changes. Once we understand equilibrium, we understand what happens when there is a demand shift or a supply shift. Yeah, when the other being constant. You could now imagine both shifting, and so you could have the magnitude impact change accordingly. In a sense, when they buy bonds, what they're doing is they're giving money in. When they sell bonds, they're taking money out of the equation, and so that's how they change the assets and liabilities in the central bank's balance sheet. Yeah. So we understand this now. That leads us to the last part, which is the liquidity trap. If we can quickly realize that the demand, at some point, they can push interest rates to zero, but not negative. Yeah, meaning they keep increasing the money supply, keep increasing the money supply, and at some point, at point B to C, that becomes flat, meaning you keep increasing the money supply, it still remains zero. So when interest rate is equal to zero, people are indifferent to whether they would hold the money or they would invest in government bonds, because it's the same. Interest rate is zero, right? And so further increase in money supply after zero interest rates will not have an impact on interest rate. Yeah. So that is super important to realize that um, there's there's only so much beyond which the interest rate will have no impact. Yeah. And what we have seen is that during 2008 and 2020 COVID crisis, when that happened, the bank reserves started to go up. The checkable deposits were also very much constant, primarily because now it becomes when more and more money is pumped into the um, economy. Um, there's only so much that you can hold, but you would eventually want it to be in a safer situation. So you would, deposit it into your bank, and the reserves would keep going up. The checkable deposits would keep going up as more and more liquidity flows into the system. Yeah. So knowing what's happening to the bankable reserves, the checkable deposits, and how they are changing over time is important to keep track of. An interesting aspect is Bitcoin as well. So we've talked about the US dollar, but will Bitcoin replace the US dollar, right? So that's a key topic. And we understand that the Federal Reserve creates money, impacts monetary policy. We saw how if they want to they increase the money supply, decrease the interest rate. That's a huge role for someone, and it's all backed by the faith of the United States government. And we see these booms and busts always happening with excesses in markets, where people get euphoric or they get depressed. And the Federal Reserve is the buyer of last resort. So, and they're able to do that because they can independently get the markets to be stable and take care of those excesses and those depressive periods. Can Bitcoin do that given its fixed amount that you can have? Its size is certainly increasing much more than when this book was published. It was somewhere around here, but it has actually gone up much more. But there are a few things that make it less likely or harder, but you never know what would happen in the future. But the biggest one is you need a trusted institution that can back the big excesses in the market, the booms, the busts, and the Federal Reserve or a trusted government body is super critical in that situation. And that trusted institution, unless that exists, it's hard for folks to move to Bitcoin completely. And also, governments wouldn't want to just give up control over the monetary policy that they currently have, right? Which is increasing the money supply, decreasing the interest rate, and when there's excesses or overheating in the economy, they decrease the money supply, increase the interest rate, and so on. So that is super big factor that's missing as to how the governments would be able to control the monetary policy. But maybe someone would argue that that's exactly the point. Folks don't want the government to control. But then a better institution, a trusted institution is needed that can actually handle these crises and be able to moderate these excesses. Similarly, the other factors being most transactions are quoted in US dollars, so you would need a critical mass of things being quoted in Bitcoin for that to start taking traction, because otherwise people have to keep remembering to convert from dollar to Bitcoin, Bitcoin to dollar, and then in most of the time it will be needed in dollars. And the thing that doesn't help with this is how volatile this is, right? You might you might be like willing to buy an asset at this price of Bitcoin, you realize, oh, it's now not even a good store of value, meaning it went from 60,000 to 30,000. Now I have to pay double. So if it's not even a good store of value, then it's volatile, and it's not having a good backing that can stay stable, rational. Um, and finally, it's expensive to be able to validate a transaction, at least currently. The technology is constantly improving. So that is going to be huge for set of factors for it to overcome before it starts to replace or has any chance of replacing the US dollar. Yeah. So we learned a lot today. We learned about the Federal Reserve. We learned about how the central bank determines the interest rate. That was the key message. But how? They determine the interest rate through money supply, to reserve ratio. If you increase the reserve ratio, then more and more money has to be parked with the Federal Reserve, and then they can change the federal funds rate, which is the overnight um, rate that the banks get for parking the money. So there are various ways in which the Federal Reserve, the central bank, impacts the interest rate of which has an impact on the economy. Because if you have higher interest rate, less people are willing to borrow, and when you have less people willing to borrow, then you will have less economic activity. Yeah. Similarly, if there's a depressive time, you would have time when, like COVID time, people were given more and more money. They were given checks in the mail, right? And so you would need to reduce the interest rate to actually spur up the economic activity. So the central bank has a huge role to play, along with what we also learned is commercial banks. And central bank influences the commercial banks by this reserve ratio requirement. And when they have kept it zero right now, it's actually an incentive for the commercial banks to lend more. Yeah, because the money multipliers effect comes in. The less you have to reserve, the more you can lend, and so on. So we learned about a pretty important aspect today about the role of central banks in determining the interest rate, which has an impact on the overall output, at least in the short run. Yeah. So we'll see you all in the next chapter, where we will actually cover what we learned in chapter 3 and chapter 4. So we learned about the goods market equilibrium, and we also learned on the financial demand for the money and supply for money. And we'll combine all of this and see how both of them work together, and we get a output equilibrium for the overall economy. Yeah, how it impacts the overall GDP. Yeah. Thanks. Bye.